Good evening, ladies and gentlemen. This is Barry Norman on behalf of Investing.com, and tonight's class is sponsored by CMS Capital Markets Traders, and you should give them a shot when you're looking for a broker. Now, tonight's class is called Introduction to the Financial Markets, a basics for beginners. We're going to be looking at what the financial markets are and what makes up the financial markets. Now, tonight's class is being sponsored by CMS, the Capital Markets Traders. And when you get time, go to www.cmstrader.com and give them a shot. Set up a demo account, give them a chance, log in, see if you like their web traders and their MT4 platform, and you'll find they're an excellent online broker. Now, remember, when you're trading in the financial markets, whether you're trading Forex, CFD, spread betting, a margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure whenever you're trading in the financial markets. Now, once again, tonight's class is sponsored by CMS Trader. You can visit them at www.cmstrader.com and try out their web trader platform. It's very easy to use, and they have one of the most advanced social networking and social signals and social trading available right on the platform as you're trading. They offer impeccable service. They have an outstanding education program, and they offer simple trading. There's no dealer intervention, no trade rooms. Just go right on and start trading. They have 24-hour support 6 days a week in all the appropriate languages. And they'll teach you all the tricks of learning how to trade in the Forex market. They offer many different trading types. You can trade micro lots. They'll offer you free daily signals. You have unlimited access to all the platforms. You get a free daily market review and technical analysis. You get all types of quick execution, and you have an account manager who speaks your language. Now, tonight we're going to be talking about the financial markets. We're not going to be talking about Forex or currencies. We're not going to be talking about commodities or gold. We're not going to be talking about stocks, and we're not going to be talking about how to trade. We're going to be talking about what makes up the financial markets and all the underlying basics. So when you're trading, you actually understand what, where, and why you are making a trade and how the financial markets affect the trade or the value of the currency. So suppose you want to start a business to develop an iPhone app, but you have no startup funds. At the same time, Mr. Smith has money to invest in retirement, from his retirement. If the two of you could get together, perhaps both of you could meet each other's needs. But how does this happen? So let's study the effects of the financial markets and institutions on the economy and look at their general structure and operations. Because all of this is what it's all about. It's all about money flow, capital, and investment. Okay, so too many people are so wrapped up in currency and the economics of it, they don't really understand all the underlying factors that really what are making up or where this all comes from and why you can make money at these things. Okay, so the functions of the financial markets is basically to channel funds from persons or businesses without investment opportunities to ones of them that do have, and to improve economic efficiencies. And it's all about borrowers and lenders. Borrowers could be big businesses like Apple. They need huge amounts of cash. They borrow money to buy new businesses. When you hear that somebody just bought a company for $15 billion, well, Intel just bought Mobileye for $15 billion. Do you think Intel has $15 billion in cash? No, they have to borrow it. Okay, now they don't go into a bank and say, can we get a loan? But they still have to borrow it. The cash, the asset has to come from somewhere. So The financial market funds are all about movement from lenders and savers, which are households, business firms, governments, and foreigners, to borrowers and spenders, which are business firms, governments, households, and foreigners. You know, you're always hearing about the government selling treasury bonds or government debt. All of this, who funds the government debt? Where does the government get the money to pay all the bonds that they have out there, to pay the interest on the money they borrow? It's all about movement of funds. So we have two types of finance. We have direct finance and indirect finance. Borrowers borrow directly from lenders in financial markets by selling financial instruments, which are claims on the borrower's future income or assets. And then we have indirect finance, which is borrowers borrow indirectly from lenders via financial intermediaries by issuing financial instruments, which are claims on the borrower's future income or assets. Okay. So the function of the financial markets is to move the funds. Is this great big massive movement of funds. When you imagine a pension fund who's got $1 trillion on deposit, well, they don't have the $1 trillion in their bank account. They bought stocks, they bought investments, and they're funding all of the global movements or markets. So we have, again, on one side, we have households, business firms, governments, foreigners who make up the capital. From that, that money is lent through direct finance directly to business firms, government, households, and foreigners, or through financial intermediaries. So like when you go to the bank to take out a mortgage, who are you dealing with? You're dealing with a financial intermediary, the bank. Okay. So this is important. For example, if you save $1,000, but there are no financial markets, then you can earn no return on this. Might as well put the money under your mattress. However, if a carpenter could use that money to buy a new saw, increasing her or his productivity, then he or she'd be willing to pay you some interest for the use of those funds. Financial markets are critical for producing an efficient allocation of capital, allowing funds to move from people who lack productive investment opportunities to people who have them. Financial markets also improve the well-being of consumers, allowing them to time their purchases better. So when we look at the financial markets, we have there's a structure to it. We have the debt market. The debt market consists of short-term loans, which usually are maturities of less than 1 year. They also have long-term debt, which is a maturity of more than 10 years, intermediary, which is in between. And this is represented in 2009, this was $52.4 trillion. In equity markets, they pay dividends in theory forever, represented an ownership claim in a firm, and the total value of U.S. equity alone was $20.5 trillion at the end of 2009. So then we break it down to we have the primary and the secondary market. The primary market is new securities issued and sold to initial buyers. An example, IPO. Who does the issuer sell to in the primary markets? The secondary market is securities previously issued are bought and resold. Example, the New York Stock Exchange and the NASDAQ. So who trades? So even though some firms don't get any money per se from the secondary market, it serves two important functions. Provide liquidity, making it easier to buy and sell securities of a company, and establish a price for securities. In other words, when a company issues all of its shares, they've sold them once. If there isn't a secondary market for these people then to start buying and selling shares of a company, who would want to have them? But if you don't have the secondary market buying and selling those shares, you have no liquidity. So you have the company sitting with 500,000 shares and some big investor sitting with 500,000 shares, but that big investor who bought the initial FREF can't sell them to anybody because there's no secondary market. So how do you judge a value, and how do you get your liquidity? How, when he needs his cash to invest in a secondary or another investment, he needs liquidity that he can borrow against those shares or sell them in the open market. Now, we can further classify secondary markets as follows. We have exchanges, which we know about: the NASDAQ, the Dow, the S&P, the DAX, FTSE. And these are where trades are conducted in central locations. We have over-the-counter markets. This is where dealers at different locations buy and sell. The best example of this market is for Treasury securities. It's www.treasurydirect.gov. It's where the government buys and sells their Treasury notes, or where you can buy and sell Treasury notes. We can also further classify markets by the maturity of the securities. Money markets, or short-term, is less than a year. Capital markets, long-term, are for more than a year. Most debt borrowers don't get involved in short-term loans. Most short-term loans are done for consumer debt type debt or small business type debt. Okay. Now, the internationalization of markets is an important trend. The U.S. no longer dominates the world stage. International bond markets and euro bonds, so we have foreign bonds denominated in foreign currencies and target the foreign markets. It used to be everybody only bought U.S. treasuries because they were safe and secure. So now we have euro bonds denominated in one currency but sold in a different market. Okay. Now these are backed by the ECB or by the Eurozone. And this is what the ECB is buying up. Now, larger than the U.S. corporate bond market, over 80% of new bonds are euro bonds. This then goes over to, we have the Forex, or the currency market, foreign currency deposits outside of a home country. Now, when you stop to think about it, the foreign exchange market, or the Forex market, was never developed for speculation. Speculation, or trading, online trading, the Forex market, is a relatively new premise. In the financial markets, central banks controlled their inflation, their unemployment, their economic situation in their country by buying and selling other types of currency, as well as making sure that they had and handling all the foreign exchange. So years ago, big corporations that were doing business all over the world needed to pay a bill in Japanese yens, and their bank would then issue a transfer via the central bank, who would then transfer it into foreign currency and pay that bill for you. It was never established to be part of this current Forex market with, investors, retail investors, as well as, all these institutional investors speculating in the value of currency. Now, euro dollars are US dollars deposited, say, London. Euro dollars are dollars that are deposited outside the US. Gives US borrowers an alternative source for dollars. Then we have world stock markets. US stock markets are no longer always the biggest, just the best known. The US has lost its dominance in many industries, auto and consumer electronics, to name a few. As a similar trend appears at work for U.S. financial markets. As London and Hong Kong compete, indeed, many U.S. firms use these markets over the U.S. markets. Now, why? Because we have new technologies in foreign exchange. 9/11 made U.S. regulation tighter. We have greater risk of lawsuits in the U.S. And the new Sarbanes-Oxley has increased the cost of being a U.S. listed public corporation. This is one of the reasons that Mr. Trump keeps harping on doing away with a lot of the regulation, because it's made it very, very expensive to do business in the U.S., to be a publicly listed company, as well as our courts are very, very lenient and pay very, very high settlements And therefore, that can be very, very costly for companies doing business in the US, which has caused a decline in some of the reason that companies used to list themselves in the US. So now, when we go back to the function of financial intermediaries, instead of savers, lenders investing directly with a borrower, investments to borrowers. That's not complicated, but that's what gets the wheel going around. Okay, when you talk about all of us that have retirement accounts, and all these retirement accounts are set with, and we need them to make money, but we're not doing the actual investing. We're not investment houses. Either we say, oh, look at that, that's a great deal over there. We don't have the wherewithal to get in. Somebody's looking to borrow, $50 million to build a new skyscraper in New York, and they're willing to pay a high payout, and they're willing to give some equity in the building, but they're only talking to lenders who can lend them $10 million a piece. You can't participate in that, but your pension fund can sure include it. So they're taking all those savers that invest in the pension fund and helping that market move. So this process called financial intermediation is actually the primary means of moving funds from lenders to borrowers. More important source of funds than security markets such as stocks. Needed because of transaction costs, risk sharing, and asymmetric information. Okay, so we have transaction costs. Financial intermediaries make profit by reducing transaction costs. Reduce transaction costs by developing expertise and take advantage of economies of scales. Okay. A financial intermediary's low transaction costs means that they can provide its customers with liquidity services. Banks provide providers with checking accounts that enable them to pay their bills easier. Depositors can earn interest on checking and savings accounts and yet still convert them into goods and services whenever necessary. Because the bank is looking to have huge amounts of capital so that they can provide this liquidity. Studies show that firms in the US, Canada, UK, and other developed nations usually obtain funds from financial intermediaries, not directly from the capital markets. In Germany and Japan, financial intermediaries exceeds capital market financing by tenfold. However, the relative use of bonds versus equity does differ by countries. So a lot of times you hear about a big corporation. In fact, Apple did it not so long ago. They were selling Apple bonds. It's not unusual. But usually Apple sells shares, but they wanted to raise huge cash when bond rates were very, very low. Even though they didn't need the money, they could sock it away. So as interest rates go up, they have a lot of cheap money that they can do business with. So financial intermediaries' low transaction costs allows them to reduce the exposure of investors to risk through a process known as risk sharing. Financial intermediaries create and sell assets with lesser risk to one party in order to buy assets with greater risk from another party. This process is referred to as asset transformation because, in a sense, risky assets are turned into safer assets for investors. Because you, as an investor in your pension fund, want no risk. You want your pension fund there when you retire, but you want your pension fund to grow. So how does the pension fund grow? They can take higher risk assets and buy into them with huge amounts of money, but provide you very low risk, because even though they might lose on one single investment, they'll bring back a return on their overall investments. Financial intermediaries also help by providing the means for individuals and businesses to diversify their asset holdings. Low transaction costs allow them to a range of assets, pool them, and then sell rights to the diversified pools to individuals. Hence, what does this sound like? mortgage-backed securities that caused all the mess in 2008. Now, the other thing about financial intermediaries, they are controlled by regulators. Everything they do is watched and very, very well laid out and has to be approved to hence lower the risk. Now, the main reason for regulation is increases information to investors, decreases adverse selection and moral hazard problems. Regulatory agencies force corporations to disclose information. Ensuring the soundness of financial intermediaries prevents financial panic. Chartering, reporting requirements, restriction on assets and activities, deposit insurance, anti-competitive measures. Improving monetary control, reserve requirements, deposit insurance to prevent bank panics. Because remember, all this is all about the economy, okay? And it's keeping the economy chugging along. When banks cause a panic, the consumer panics, the consumer stops spending, and the economic wheel stops cycling. And it's very, very hard to get it back. But this is all the basis of the financial markets, is the movement of funds in the safest, easiest manner to allow large investors to make large profits. Asymmetric information in financial markets means that investors may be subject to adverse selection and moral hazard problems that may hinder the efficient operation of financial markets and may also keep investors away from the financial markets. Each country's regulatory agency requires corporations issuing securities to disclose certain information about their sales, assets, and earning to the public and restrict trading by the largest stockholders known as insiders in that corporation. Such government regulation can reduce adverse selection and moral hazard problems in financial markets. Okay. Indeed, the SEC, each country has their own regulatory agency, such as the FSA in UK. When we refer to SEC, which is the largest in the world, we are talking about each country's agency, has been particularly active recently in pursuing illegal insider trading. Because the financial intermediary market is designed to be safe. For those big corporations or big investment who want large risk, they're supposed to do this outside of financial intermediaries. This is where you have the direct lending, where they take on the risk, but they can't risk your money. So, but this is all the basis of the whole financial cycle and the whole financial markets. Asymmetric information makes it difficult to evaluate whether the financial intermediary are sound or not, and can result in panics, bank runs, and failures of intermediaries. What did we see happen throughout the US? Or you can look at the Greek crisis, the Italian crisis, okay, when these intermediaries were losing money and had risky investments in the marketplace, and we saw panic, we saw bank runs, and we saw the failure of these intermediaries. Intermediaries are not just banks, okay? There are many intermediary organizations that are all made part of it. I mean, in the US, you have Fannie Mae, you have all kinds of mortgage companies, all kinds of lending companies, you have all kinds of, and what happened was, all of a sudden the central banks had to step in, not just to save these, but they also had to put liquidity back into the markets, okay? Because not only were the financial intermediaries failing, but the direct financing was drying up. So big businesses who could go direct couldn't find the funds to borrow to grow their businesses. So regulation reason ensures soundness of the financial intermediaries to protect the public, the economy from financial panics. The government has implemented 6 types of regulations: restriction on entry, disclosure, restriction on assets and activities, deposit insurance, limits on competition, and restriction on interest rates. Now, regulators created very tight regulations as to who is allowed to set up a financial intermediary. Individual groups who want to establish a financial intermediary, such as a bank or an insurance company, must obtain a charter from the state or the federal government. Only if they are upstanding citizens with impeccable credit credentials and a large amount of initial funds will they be given a charter. Okay. There are stringent reporting requirements for financial intermediaries. Their bookkeeping must follow certain financial strict principles. Restrictions on asset activity. Restrictions on the activities and assets of intermediaries help to ensure depositors that their funds are safe and that the bank and the other financial intermediaries will also be able to meet their obligation. Now you're saying, why is this important to me as a trader or investor? Okay. Because all of this has an effect on the economy, which has a direct effect on the value of its currency, as well as a direct effect on the stocks that are trading, as well as the exchanges, as well as gold or oil, or because all of this is based. Right now, we know that the oil companies in the US, okay, and even in Europe, the oil production are having a hard time financially because oil prices are so low. Now, these producers, or whether they're Exxon, Shell, or Mobil, have to raise cash at all times. Now, they have billions and billions of dollars in assets, but if they need to expand, they want to do something. Like ExxonMobil is now selling off assets, okay, because they need to raise cash. They need to pay their bills. Okay. How do they pay their bills? They either borrow huge amounts of money from financial intermediaries, they sell bonds to raise cash, they have a stock sale to raise cash. All of this has a value effect on the value of their shares, because the more debt they get into or the more assets they sell off of, the less value that company has. And what they're doing is they're borrowing against their future earnings. So all of this has an implication. So oil gets affected by the financial markets. It's all part of how the underlying thing is moved. I mean, when you're looking at, look, everybody's thinking the pound was trading at an all-time low. The FTSE is facing Brexit. The UK is in a major set of uncertainty, and everybody's waiting for Mark Carney to start talking about raising interest rates. Why would he consider raising interest rates from the Bank of England when the country is in a mad tizzy at the moment? Think about it. But he's not looking at the value of the pound. He don't care. He's not looking at today. He is looking forward to Brexit, but he's looking at all the wheels and the spokes that make up the financial markets and how they move. Now, also the financial markets limit competition. Although the evidence that is unbridled competition among financial intermediaries promotes failures that will harm the public is extremely weak. It has not stopped the state and federal governments from imposing many restrictive regulations. Now, if you're in the UK or you're in the US, you see very little of this. But when you start looking at countries around the world, you see how much they're antitrust and they're anti-competition, or some countries that have no competition, some countries that are trying to bring in competition to bring down prices. The less competition you have, the higher prices are. Okay, so the financial markets want to control competition and keep it equal and balanced. Competition has also been inhibited by regulation that impose restrictions on interest rates that can be paid on deposits. These regulations were instituted because the widespread belief that unrestricted interest rate competition helps encourage bank failures during the Great Depression. Later evidence does not seem to support this view, and restrictions on interest rates have been abolished. Okay. Now, we have something in most countries called usury, where it is restriction on what money is loaned for, because that affects the consumer and how. In fact, credit cards are very well limited, because what happens, credit card companies take advantage of the consumer. And so we do have limits on those, and the countries continually push them back down, because we have credit cards out there that you miss a payment, before you know it, you're paying 22% on your debt. Okay. And this cannot allow to be happen. This can't happen because you can never dig your way out of it. And when you have lots of consumers who can't dig their way out of their debt, there's no reason for paying their debt, which then increases more bad loans, which increase failures, which increase everything. And improve monetary control, because banks play an important role in determining the money supply, which in turn affects many aspects of the economy. Much regulation of these financial intermediaries is intended to improve control over the money supply. And money supply has a direct effect upon currencies. And the central banks have a big effect on currency. A higher interest rate being charged by the central bank means the banks are paying higher rates on deposits, means it invites foreign investment or foreign deposits. One such regulation in reserve requirements, which makes it obligatory for all depository institutions to keep certain fractions of their deposits in accounts with the Federal Reserve System, the Fed, the central bank of the US, or the ECB, or wherever else, because we reserve, by controlling reserve requirements. Actually, if you notice, when China wants to do monetary quantitative easing, what they do is they drop the reserve requirement for their banks. That opens up a lot more money that can be loaned and pushes money flow out into the marketplace. And they're not pushing money flow out into you and me who are borrowing $10,000 to pay off some debt or to buy, they're pushing this out to attract businesses and to loan money to businesses, so business will do capital expenditures or improvements, and therefore create more jobs. Those countries with similar economic systems also implement financial regulation consistent with U.S. model. Japan, Canada, and Western Europe, financial reporting for corporations are required. Financial intermediaries are heavily regulated. However, U.S. banks are more regulated along dimensions of branching and services than their foreign counterparts. The function of financial markets. We examine the flow of funds through the financial system and the role of intermediaries in this process. The structure of financial markets. We examine market structure from several perspectives, including types of instruments, purposes, organizations, and time horizon. So internationalization of financial markets. We briefly examine how debt and equity markets have expanded in the international setting. The functions of financial intermediaries. We examine the role of intermediaries in reducing transaction costs, sharing risk, and reducing information problems. So the type of financial intermediaries. We outlined the numerous types of financial intermediaries by further examining in later chapters or later classes. Regulation of the financials. We outlined some of the agencies charged with the oversight of various investments and markets. So we initially come down to two types of markets. Okay, we have the capital markets. Okay, that is the flow of capital around the world. And then we have it broken into the direct and the indirect, the flow of the money. So we have, hold on a second, I just want to get to the beginning. So we come down to the wheel, the turning of the wheel. We have how it's all about channeling funds from persons or businesses to borrowers and spenders. Okay. And it all comes down to this constant flow of money. Okay. And this is the basics of all the financial markets. So whenever on the left-hand side we have households, business firms, government, and foreigners, it is if any of those start no longer savings. Okay. In other words, when job market gets scarce, people eat up their savings. There's less household money into the banking system, which therefore creates the the liquidity for the borrowers or spenders. When business firms also are tapped out and business isn't good, or the government cuts spending and whatever, and if the money isn't flowing, then the central bank has to step in. And you'd be surprised, foreign investment is very, very important. It's a huge amount of money flow. Okay. And remember, we have direct finance and indirect finance. Most of the transactions we see on every day are indirect finance. But when you hear and you read about all of this stuff going on in the markets, you read about bond sales, Eurobond, okay, all of this is direct because it's coming to, or these big bond sales that are not, that we can't get to. Okay, this is because it's direct financing. When Apple, okay, or a lot of times you hear, what's his name, the big investor, some corporation goes to this one big investor or one big financial firm, or goes to JP Morgan Chase. They go directly to the money source and make all of their financial arrangements right there. So it's all about how the financial markets are functioning and the liquidity. And this is what we're ultimately concerned with. This is the underlying movement of whatever you're doing in the market, whether you're buying shares, whether you're trading CFDs, whether you're buying currency, whether you're investing in bonds, ETFs, all of it's going to flow. And if there's some kind of a delay or some type of gap in this system, okay, it's going to have an effect on every asset you're looking at. By understanding the underlying movements, you can then help predict whether the asset you're looking at should be volatile or not volatile, should be going up or should be going down. It's not going to help you decide whether the euro should be at 107 or 108, but it can tell you that the euro should be very weak or very strong. It should tell you whether the FTSE should be going up, if stocks should be climbing, because it's all about this steady flow of financials. So imagine Apple wants to start buying up companies, or Intel, but they can't arrange the financing. They don't have the liquidity. They can't get the cash to buy the companies. They can't get the funding to start a new project. And this happens. Okay. And all of this is critically important. So thank you very much for joining us tonight. Have a great trading week. Thank you for being part of the Investing.com family, and give CMS a break. Go to www.cmstrader.com and set up a demo account. Try out their platform. You'll find that it's a very easy place to trade. Have a good night now, and see you again in next week's classes. Bye now.